So QBE is basically a business that has two parts to it. There's the insurance part of the business and there's the investment pool. Now let's speak about the investment pool first because that's what initially attracted us to the opportunity at QBE. Now QBE has about $30 billion of prepaid gross written premiums. If you think about it as a consumer of insurance products, you basically prepay for that insurance that sits within the insurer's balance sheet that they can then invest at market rates. Now, the insurer doesn't want to take on too much risk because they then have to pay that money out in claims. So they invest it within, traditionally government and other types of bonds. Now, if you think back the last few years, interest rates close to zero, insurers like QBE haven't now been able to generate much return on those investment pools. With interest rates now at 3 to 4%, that pool of investments, which in QBE's case is close to $30 billion, can now generate a return up to 4% on that investment pool. So in QBE's case, that's an extra $1 billion plus of income they previously weren't able to access. So that for us is an interesting starting point for the business. Then you look at the insurance part of the business, it's actually been performing quite strongly in what we would consider a reasonable turnaround for that business. Now you look back historically over the last few years, the US part of the business has been underperforming for a number of reasons, but we've started to see signs of operational improvement, particularly within E&S, which they've reinsured. The catastrophe part of the business, they've actually increased the provisioning there. And middle market, we think there's a bit of operating leverage as they start to increase the penetration through some of their distribution lines there. We're seeing strong signs of a turnaround there, and we're seeing the US business or the North American business actually generating positive insurance margins for the first time in a number of years. So we think there's the elements in place to see the QBE business start to provide more normalised returns and attract kind of more generalist investors that have probably been scared off by the volatility previously in the business. So our insight was originally that investment pool would generate higher income than the market was expecting. If we go back to when we first started investing in the business, the investment community was probably using a long-term interest rate of about 2% on those investment pools. With the long-term cash rate looking at 3.5% to 4%, we thought the investment income available to QBE was a lot higher than what the market was expecting. Now, the market has caught up somewhat, so we think that's less of an insight now. But when you think about the business that's engineering quite a strong turnaround operationally, to be trading at almost the biggest discount that it's traded on a 2-year forward basis at about 7.5 to 8 times, we think doesn't reflect the elements of that turnaround that are in place. We've historically seen QBE as a 12 to 14 type of business, and trading at 8 times, we still see quite material upside if the market can start to accept that turnaround is in place and they are actually executing quite strongly. So if you think about QBE and you look at it as 12 times earnings, we get a valuation of close to $20 on about a 2-year view. Now, if you discount that back, we think a valuation of $16 to $18 is potentially achievable if they were to retain their multiple and the market starts to recognise that turnaround. I think with the weather that we've seen impacting the east coast of Australia, I think weather and catastrophe claims has been front of mind for most investors. So I think that's probably capturing some negativity towards QBE, despite the positive elements we've seen with interest rate opportunity for them and also the turnaround that we're seeing in the US business. Now, we had the opportunity recently to speak to a crop expert in the US and we were quite, pleasantly surprised as a QBE shareholder that the cropping season has actually been, benign, which is probably a positive. So I think there's probably elements of the market that might think that with the hurricane season that had transpired that there might actually be some risks around the US cropping season. But it's actually been, the feedback that we received, it's actually been a pleasing, season for insurers for that crop because yields have actually been stronger than what people expected. There probably has been a few elements of quality issues, but with the yield as strong as it is, we think that that's quite positive for QBE in the near term. As a reminder, the US business is probably about 40% of their overall business and crop is almost half of that. So we're talking almost a quarter of the business that we've heard, positive signs and feedback from.